Good morning to everyone. Myself M.GOMATHI, Assistant Professor in Commerce CA. Today I will discuss the topic Financial Management. First, what is finance and management? Finance is the lifeblood of the firm. Management is the planning, organizing, directing and controlling the financial activities. That is financial management. Next, introduction to financial management. Branch of economics that studies management of money and other assets. It is considered as lifeblood of business. It provides access to all other resources required for business. Next, meaning of financial management. Financial management is a vital activity in any organization. It is the process of planning, organizing, controlling and monitoring financial resources with a view to achieve organizational goals and objectives. Next, definition of financial management. The financial management is the activity concerned with planning, raising, controlling and administrating of funds used in the business. Gautam and Dogal. The financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operation. Next, nature of financial management. Indispensable origin of business management. It is a continuous process different from accounting function, coordination with other departments, decision making for top level. Next, scope of financial management. First, financial decision, investment decision, dividend decision. This is the scope of financial management. First, financing decision. Managers also make decisions pertaining to raising finance from long-term sources called capital structure and short-term sources are called working capital. Next, investment decision. Managers need to decide on the amount of investment available out of the existing finance on a long-term and short-term basis. Long-term sources are land, machines, etc. Short-term source, current assets. Next, dividend decision. This involve decisions related to the portion of profits that will distributed as dividend. Shareholders always demand a higher dividend while the management would want to retain the profits for business needs. Next, what are the functions of financial management? Determining the financial needs, selecting the sources of funds, financial analysis and interpretation, capital budgeting, cost volume profit analysis, profit planning and control, dividend policy. Next, what are the objectives of financial management? This is the main objectives of the financial management. First one, profit maximization. Second one, wealth maximization. And third one, maintenance of liquid assets. This is the main objectives of financial management. And other objectives of financial management are building up resource for growth and expansion. Next, ensuring the financial disciplines in the organization, efficient and effective utilization of financial resources. This is the major objectives of the financial management. Next, profit maximization. Profit act as a measure of efficiency and it serves as a protection against the risk. This is the profit maximization. Next, What are the advantages and disadvantages of profit maximization? First, advantages: economic survival. Second, social welfare. Third, economic welfare. Fourth one, efficient allocation and utilization of resources. Next one, profitability meets all needs. This is the advantages of profit maximization. Next, what are the disadvantages of profit maximization? These are the disadvantages of profit maximization. First one, ignores the time value of money, overlooks quality aspect, term profit is what, ignore the risk, short sighted. This is the disadvantages of profit maximization. Next, what are the arguments in favor of profit maximization? First, when profit earning is the main aim of business, the ultimate objective should be profit maximization. Second one, future is uncertain. A firm should earn more and more profit to meet the future contingencies. Third one, profit maximization is justified on the grounds of rationality, as profits act as a measure of efficiency. Next, arguments against profit maximization. First, profit maximization leads to exploitation of workers and consumers. Profit maximization ignores the risk factors associated with profits. Third one, profit in itself is a voyage. Its concept and means differently to different people. Next, it is a narrow concept at the cost of social and moral obligations. Next, wealth maximization. Wealth means shareholders' wealth or the wealth of the persons involved in the business concern, and also known as value maximization or NPV, net value maximization. Net present value is the difference between the present value of benefits realized and the present value of cost incurred. Next, what are the advantages and disadvantages of wealth maximization? First, advantages. This is the major advantages of wealth maximization. First, it serves in interest of supplier, shareholders and employees. Next, consider the concept of time value of money. And next one, takes both quality and quantity factors. This is the major objectives of the wealth maximization. And next, disadvantages of wealth maximization. This is the disadvantages of wealth maximization. First one, it ignores the short-term economic benefits. It is indirect profit maximization. It is conflicts to interest in the management when management is separate from ownership. This is the disadvantages of wealth maximization. Next, what are the arguments in favor of wealth maximization? Due to wealth maximization, the short-term money lenders get their payments in time. The long-term lenders to get a fixed rate of interest on their investment. Next, the employee share in the wealth gets increased. The various resources are put to economical and efficient use. Next, what are the arguments against wealth maximization? Wealth maximization is socially undesirable. Wealth maximization is not a descriptive idea. Wealth maximization, only stockholders' wealth maximization is encouraged when ownership and management are separate. Next, what are the difference between profit maximization and wealth maximization? First, profit maximization is old concept, but wealth maximization is modern concept. Second one, it is easy to calculate, but wealth maximization is difficult to calculate, and profit maximization is what's concept and wealth maximization is clear concept. Profit maximization ignores time value of money, but wealth maximization concept consider the time value of money, and profit maximization ignores the risk and uncertainty, but wealth maximization consider risk and certainty, and profit maximization is short term, but wealth maximization is long term. This is the major difference between profit maximization and wealth maximization. Next, what are the principles of financial management? First, the risk return trade off. Investors would not take additional risk unless they expect to be compensated with additional return. Second one, time value of money. A dollar received today is worth more than a dollar received a year from now. Third one, cash not profit is a king. It is cash flows, not profits, that are actually received by the firm and can be reinvested. Next, incremental cash flows. It is only what changes that counts. Next principle, the curse of competitive markets. Why it's hard to find exceptionally profitable project. Next principle, efficient capital markets. The capital markets are quick and the prices are right. The next principle, the agency problem. A problem resulting from conflicts of interest between the manager, agent and stockholders. Next principle, tax bias, business decisions. Next principle, all risks are not equal. Some risk can be diversified away and some cannot. Next principle, ethical behavior is doing the right thing. This is the major principles of financial management. Next, role of financial manager. Financial manager is one of the person who is managed the financial activities in our business. That person is called financial manager. That financial manager roles are given below. First, funds raising and funds allocation, profit planning, understanding capital markets. This is the role of finance and financial manager. The first role, business forecasting and determination of financial objectives, financial policies and operational procedures. And next, estimation of the capital requirements of the business. Next, designing the capital structure, determination of the proper sources of finance. Next, investment decision. Next, ensuring the supply of required funds. Next, controlling the use of funds, profit planning and disposal of surplus or profit or dividend decision. Next, management of working capital. Next, helping in valuation decisions. This is the major role of financial manager in our business. Next, sources of finance. All types of businesses need money to start up, stay in business or to expand our business. Here is an overview of the types of finance available to businesses. This is the sources of finance. The finance source divided into two categories, internal source and external source. The internal source are divided into working capital, retained earnings, sale of assets, and the external sources are divided into three subcategories. First one, external short-term source and external medium-term source and external long-term source. This is the external sources of finance. First, external short-term source divided into credit card, overdraft, factoring and trade credit. These are the external short-term finance source. And external medium-term sources are leasing, hire purchase and medium-term loan. And the external long-term sources are sale of shares, venture capital, new partners, long-term loans, mortgages, bonds, debentures, grants, etc. These are the external long-term sources. This is the source of finance raised in our business capital.